Same.
Good morning, everybody. Welcome to this week's edition of Academic Market Insights. This week is a pretty exciting week because Dr. Rhodes, aka Dr. Rove, is going to be speaking on what he's been speaking about for the last couple weeks. And I think today's your last show with this,
The
I
last
think.
one that I'll be doing, yes.
Yeah, okay.
I'm in the luxurious Hampton Inn at exit
Woo-hoo!
253 on I-65 or on
Woo!
yeah, on I-65 in northern Indiana. I'm speaking in Maryville this afternoon at lunchtime. Today's November 15th. Uh,
November 15th.
just to give
So
the date perspective on the predictions.
So Dr. Rhodes has
Mhm.
been requested by Indiana University to speak throughout the great state of Indiana, about the forecast for the next year. And this is a roadshow called the Futurecast. So again, a handful of faculty members are selected to do this, and this is something that Indiana University has done for decades. So he's going to be discussing what we think or are trying to predict for the next year. And if you saw our video last week, you know how wonky things are right now in the markets. So we have to take that with a grain of salt. I think Mark Twain said it best. It's very difficult to make predictions, especially about the future. So having said that, Dr. Rowe, why don't you take it away?
Absolutely. So it's kind of funny you say that predictions are very difficult, and that I was selected to do this. I think a lot of professors, especially for the section that I do, d- don't want to be on the hook saying this is what I think is going to happen with the stock market, and then the next year, because predicting the stock market is very difficult, and all you really can do is give a general outlook from the time that you're at right now. And that's one of the reasons I wanted to emphasize that today's November 15th. Things can change on a dime, and I'll get into that. But first, I want to talk about what the Futurecast is. It used to be called the Business Outlook or something like that. Uh, it's an annual series of events across Indiana. What we do is we go and speak to community groups. I spoke to the Rotary Club of Jasper, Indiana yesterday. That was a lot of fun. Went to the IU Columbus and IU Southeast campuses. It had almost 300 people at both of those events, and it's not 300 students. It's mostly people from the community, and it's an annual thing for a lot of these people. I've been doing this for 4 years, so I see a lot of the same people over and over again. And most of the outlook is Kelley faculty. Uh, it depends on where we are, but typically, and I'm going to make sure I get this right, I've got my Futurecast handout. We do the US global economy, Indiana economy, and then the finance outlook is the financial markets. That's the part that I'm responsible for. And then if and then at some of the stops, we'll have somebody that's a local businessman or maybe a local academic, et cetera, who talks about the local economy. And this coincides with a forecast issue of the Indiana Business Review. And this is one of those cool things about being associated with a school like Kelley. This is the 99th year that this has been done. And I just I'm trying to do a really good job because I really want to be involved in the 100th anniversary of it. I think that just being able to hang your hat on that one. But there's a forecast issue of the Indiana Business Review that comes out typically first or second week in December. Once that's out, there'll be a link below that somewhere below, I will put a link to how you can see that. I did want to, before I get into what I have been saying for my part of the Futurecast, I didn't want to just go to the website real quick. And this is the Futurecast 2025. It used to be called the Economic Outlook, still says Economic Outlook up there at the top. Uh, these are all of the stops. I did 7 of these. Indianapolis and Bloomington, Columbus, Jasper, Johnson County. I did not do Kokomo, New Albany. For those of you that don't have a map right in front of you, that's at basically Louisville. Northwest Indiana is Maryville. That's where I am today. And I am not responsible for Richmond, which is, if I remember correctly, on the eastern part of the state and kind of close to Dayton and Cincinnati. And we all know where South Bend is. There's another college there, but we do have a IU South Bend campus there. Uh, concluding in Richmond on November 21st, next week. Here are the speakers. Kyle Anderson works very closely with Dr. A and I. Um, Andrew Butters has done the international and even did the Indiana economy at one of the stops. There's our current dean. There's Carol Rogers, who is in charge of the IBR and herds all the cats involved in the Futurecast schedule. And there you can see the schedule that we've been keeping up with. I did all but Kokomo on this list up to Northwest Indiana. Didn't realize I had that many of them. But that's the Futurecast schedule. Again, we're toward the end of it. This does coincide. We basically are given the highlights of papers, plural, on all of those different topics, including multiple papers on different local economies in Indiana. So it's like a comprehensive Indiana national, international financial market outlook. And there are some models that we depend upon when we put the outlook, put the Futurecast. Used to be called the Outlook, so I'm gonna keep using them synonymously, but we do have a model that dictates uh, a lot of what we say at our presentations. Now, my presentation was on the financial markets. I noted that we've had a really good 2023 and 2024. Valuations are at a very, very high level. So I'm not overly bullish on the stock market going into 2025. Now, the consumer has we usually have three positives and three negatives associated with our outlook. The consumer has been very resilient, surprisingly resilient throughout 2024. We are seeing rising credit card and car loan delinquency, so that might be something that starts to put a little pressure on the economy and financial markets. Now, the rate environment is mildly favorable for stocks. Um, the issue with the rate environment is when we started working on the Futurecast, uh, the uh, the financial markets were expecting pretty aggressive cuts and for the risk-free rate or the Fed funds rate to bottom at 3.5% in December of 2025. In the last 3 weeks, that number has risen to about 3.7% and been pushed out to December 2026. And things like that would, I know I'm on the positive and I'm starting to bring up the negative, but things like that would result in a less favorable rate environment. And the stock market has been very, very interest rate driven. Yes,
So I'm kind of curious to tease out that idea a little bit more, um, because when I think of higher risk-free rates, I would assume that that's going to be a bad thing for stock markets. And the
exactly.
reason why,
Exactly.
okay,
Yeah.
and there,
No, I was
okay,
saying
good.
now where it says mildly favorable. We are expecting rates to go to work their way down. Uh, what I'm seeing in the markets now is instead of 3.5% by December 2025, I'm seeing 3.8% by December 2025. So, that's why I put that mildly in there because we do expect them to trend lower, just not as aggressively as people thought even 3 or 4 weeks ago. And I'll get into why I'm using that word mildly and a lot of hedge words around this one as well when I get to the negatives. And our models are predicting 2.1% GDP growth in 2025. Not exactly the most positive numbers in the world, but not necessarily terribly negative. Now, I was at a presentation Wednesday night that somebody else was giving. I've had so much. I've had chicken and mashed potatoes like 7 meals this week because I've been at all kinds of events. Uh, and at that event, somebody else was speaking, and they were fairly conservative. And he noted that, and I wrote this down. I really want to investigate it a bit more, but he noted that he feels like a lot of the growth that we've had in the last 3 or 4 years has been artificial and driven by government spending,
Mm,
and he doesn't consider that a
mm,
true contribution to GDP. If we see that cut with the new administration that's coming in, that might be a bit of an issue with respect to GDP growth. So I'd be a bit concerned, even though these are positives, if they hold up for what's expected right now, be good for the stock market. But I think there's some risks there. And then on the negatives, inflation.
sorry,
Yep.
I'd
Oh,
like to
sorry.
go back,
I
really
get all
quickly.
fired up. Go ahead.
Sorry.
Mhm.
Just from an academic standpoint, the reason why we're talking about or how this gets embedded is when we think about stock valuation, it is a discounted cash flow, and that return on equity, if you use a CAPM model, it's the premium or the return over the risk-free rate. So if you've got a high risk-free rate, you've now created an additional hurdle. So this is one of the reasons why when we think about that risk-free rate, we can start to see how it's going to impact the actual valuation and the value of those stocks within the stock market. So I just want to make sure that for those of who aren't thinking about where does the risk-free rate actually plug into valuation of the stocks, this is where it slides in. And so understanding, as Dr. Rose is talking about, how things change, you're going to see a direct impact or change in impact in your stock valuation and the broader stock market.
No, absolutely. And the lower rate environment it just makes doing business so much easier.
Does.
And the expectation around that, if it doesn't hold up, it can cause a lot of difficulties for companies, both on the valuation, both on how we're doing our valuations, but then also just on on their profit margins, how much is capital costing them, et cetera. So it can be a double negative for
Yeah.
companies. The cost of capital and then the hurdle rate just for the returns that are expected. Both of those become a little bit more difficult. Now, my big concern continues to be inflation. And you'll hear the pundits again, this is mid-November. You'll hear pundits on TV talk about how inflation seems to be somewhat under control. When we're doing the Futurecast outlook, the outlook for the U.S. right now from in IBR and from the Kelley School is that we're not going to have much of an issue with inflation in 2025. Um, I question that a bit because of what we see within the rate market, where we're seeing the level of rates, the level of the low end of where the expectations are for rates in 2025. With that number rising, that is an indication that the market thinks the Fed's not going to be very flexible. And one of the reasons that they would not be flexible is they can't cut rates in an inflationary environment. They just
Mm-mm.
can't. What ends up happening is if you're having to cut rates in an inflationary environment, you've got stagflation going on. You've got very slow economic growth, but you've got prices going up at the same time. And if you cut rates, that's going to have a negative impact it's going to cause prices to rise even faster. It might help with economic growth, but the dual mandate of the Fed, it becomes very difficult to deal with because their mandate is try to keep interest rates as low as possible or at a level that will foster close to full employment and solid economic growth without causing inflation. So if you're seeing slow economic growth and high inflation, uh, typically those two things don't go together, but that's kind of a nightmare scenario for the Fed. Uh, with all of the different raises and increases in salary that we've seen, the longshoreman thing, Boeing, et cetera, we are going to see average hourly earnings go up over over the near term, and I think that's going to result in higher prices as well. Yes, Dr. Alpha.
Um,
I'll go with Dr. Alpha this time.
okay. Well, you brought up stagflation, and I know that stagflation happened in the late 70s. Is that
Yep.
correct?
Yep.
Do you know if it's happened other times?
Nothing that's popped up. It's funny. I listened to there's an academic who did her graduate work at Berkeley, and her name escapes me. In the driving around, I've gotten to listen to a lot of other podcasts, and there's a new book out, and it basically does go through the history of some of the Fed action and inflation, et cetera. And they did not talk about potential stagflation. And a lot of it had to do with how different people with different political outlooks view inflation. Apparently, people on the blue side of things actually did not think inflation was a problem over the last couple of years, while people on the red side of things actually did. I'd never heard that before. and I've got to take her word for that. I don't know of other periods of stagflation. You know what? I would not be. You said when you said 70s, do you mean the early or late?
I'm drawing a blank.
Because I'm thinking of the Arab oil crisis, and then
Mhm.
that created higher prices, and our economic growth it was anything but pretty. I was my I grew up. I basically was 3 years old in 1970, and I was 13, and I was 13 years old in 1980. So I do have a little bit of a recollection of the late 70s and just how difficult my family had issues with respect to how difficult the economic environment was back in the 70s. I was a kid, so I didn't really fully pick up what was going on, but prices going up and the economy very slow, that is just a very bad combination. And the tools that the Fed has, they can't do a whole lot about that without making one of them worse. So I'm paying very close attention to any economic number that comes out that could indicate inflation. I think where it will show up first, if it does show up, and if it doesn't show up, they may not let me participate in the 100th anniversary of this thing because I've been all over it on this roadshow. Um, I think it will show up in the average hourly earnings or something like that in the monthly employment number, and then it'll work its way to maybe the CPI or CPI, probably CPI, but and PPI as well. So that's the one thing that I'm keeping a very close eye on. Valuation stocks are at the high end of their valuation metrics. I think they're Schiller PE, it's in the 95th percentile right now. So and that's not a reason for stocks to go down. Stocks can stay overvalued for a long, long, long time. I mean, like, several years. But the higher the valuation, the bigger the fall when we do get some sort of negative catalyst for the markets. So that's one of the things I'm a little concerned about. And then geopolitical, you really can't quantify these too much. And I put these in the order of concern. And I find it very funny that Ukraine is third. I mean, that's a hot war with over 1 million people either killed or at least hurt to the point of where they could not make it back to the battlefield for both sides. And that's number three. China has some real problems with their housing, and you'll hear pundits refer to the housing situation in China as similar to what happened in the United States in 2008. It is
Okay.
so much worse
Mm.
because when you take a mortgage out in the US, you take it out and you get to move into the house. When you take a mortgage out in China, they start building your place. So people are paying mortgages on homes that aren't even being worked on right now. Because what
Wow.
the property companies would do is you put your money down, start making your mortgage payments, and they use that capital to start the next project. It's almost like a Ponzi scheme of how they're using that mortgage money. So why would you continue to pay on your mortgage if it looks like the house is never going to be finished? And
Sure.
that's a lot that approach to housing makes that situation so much worse than it would be in the
Right.
US. China's a large holder of our debt. They sell our debt, interest rates go up. Period. That's just market
Hmm.
forces. And then also just how belligerent they continue to be, pushing people around in the South China Sea, claiming the whole South China Sea for their own. That could also escalate very, very quickly. I don't think the Middle East or Ukraine need much of an explanation here. We everybody knows what's going on there. Really, the China one is the one that I think is going to surprise a lot of people. Yes.
So I was thinking about if China starts to offload the US debt and starts to sell it, the
Mm.
only way we can really counter those interest rates going up is we need somebody to come in and start buying. So the US government might be somebody who's going to start to buy, and
Oh, I
then
could
that's
see that.
going to, pardon me?
I could see that if we get a bad auction, totally see that.
Mhm. And then
Yeah.
so they come in and they start to buy, and now we have a surplus on our balance sheet. So it creates a unique or interesting situation. There is a possibility that another sovereign nation is going to come in and start buying up that debt. But that is a genuine risk because most likely there's not another sovereign nation that will come in, let alone come in and buy that much of our
Exactly.
debt
Yeah, and
because
I don't
they,
think they have the money.
right.
I've always felt like China has less, let's call it risk capital, but capital that they could, that they could have options as to what to do with. I don't think I've thought this since 2008 that we always believe that China has more money than they really do, and the reason is they were immune to a lot of what happened in 2008. And I do know that there were overtures to see if China wanted to invest in some of our banks. Thank goodness they did not do that. But I think that they shot it down so quickly because they really didn't have the money to do it.
Yeah, and I'd like to piggyback on that. In the mid 2000s, remember, we also had currency wars.
Oh yeah,
So
yeah.
we had our own financial crises here in the States, but then we had China artificially deflating their own currency to lower their prices so that Americans would continue to buy more. But this was artificially done. So if in a at a typical market, if they've got goods that they're selling to Americans, Americans are buying more and more, and the demand is going up, that's going to push prices up. And again, China artificially lowered their currency. They devalued their own currency so that they could still generate more of those American dollars. And there comes a turning point where that's no longer going to work, especially given the possibility of the new tariffs coming along. So it's an interesting environment of what will China be able to actually do if they're not getting the surplus of US dollars from the goods that they're selling, and then they have this glut of debt that they could theoretically sell to prop up their currency and to prop up their economy.
So the situation with China, it actually, and as I noted, we talk about the financial markets, but we also do a forecast for the Indiana economy. And the Indiana economy, we're the 10th largest exporter in the US. We're right in the middle of the country, and we're the 10th largest exporter. And it's because we're very much of a manufacturing,
Mhm.
so, very much of a manufacturing center. And heck, you and I see going up and down I-65 how much stuff gets moved around the state every day. It's and it really it's something being moved from one production facility to another intraday. I've talked to some of these truckers when I've stopped at some of the places on this road show, and that's exactly what they're doing. Yes, I go to Fort Wayne and then back and forth between these two facilities twice a day. Drop this off and they put it right to work. It's like some just-in-time manufacturing. We have benefited from some of the manufacturing coming back to the United States, which has been a very logical thing to do after COVID. And we suddenly realized that there were some downsides to the globalization. There are a lot of US companies that continue to move production away from China, but they do it quietly. I did see a news article when I was prepping for the roadshow about Apple. Apparently, Apple just opened their first R&D center in India, and they plan to double the number of iPhones made in India. I don't know what the base number is, but they plan on doing that between now and 2027. Sounds to me like the next generation of iPhone will probably uh, more likely come from India than China. So the fact that a lot of people are turning away from China, and at the same time, there are talks of tariffs, and a lot of people, especially in the academic end, we automatically don't like tariffs. I feel like the reason that we're talking the President-elect Trump is talking tariffs right now, I almost feel like it's a negotiating tactic
Mhm.
because China doesn't really have much of an opportunity to reciprocate. They don't really buy that much from us, and one of the main things that they buy is soybeans. And they did put a small tariff on soybeans back when Trump was president, and I think at some point they rolled that back. But they got to feed their people, and if that's the one thing that they can fight back with is on food, you're not going to want to do that, especially when your economy is already in some trouble. So I feel like uh, talking about further tariffs, et cetera. I feel like it's an opening negotiating tactic. One of the questions I got at one of the earlier roadshows, I really like how this guy phrased it. He said, if you're going outside for all of 2025, are you taking an umbrella or not? And I said, if I've got to go outside in 2025, I'm sitting on the porch, and then on January 20th, I'm going to look at the weather, and then I'm going to figure out if I need the umbrella or not.
Right.
I am paying very little attention to a lot of the things that are being said. And that's because stocks behave very, very differently between when he got elected in inauguration than after inauguration. Small caps outperformed tremendously. Then they underperformed for a good portion of his presidency. I just really want to, I want to get to January 20th. I'm basically all cash at this moment in my short-term stuff. Wait, because I really think the best way to be right now is wait and see and not trade on or take positions based on what is said from day to day.
Sure.
Um, so there, just the final, and this is really what I'm supposed to tie things around to. The stock market outlook at best below average performance in 2025. I and that's what we say in the paper. I am allowed to incorporate my own opinions into these things, which I think the people that show up for the talks and maybe the people that are watching this appreciate. I do think that you'll have a better opportunity to buy stocks in 2025 at some point, either due to some sort of geopolitical situation, uh, using that valuation kindling to light a fire, or if we start to see a resurgence of inflation and that pushes out interest rate cuts. The couple of times that we had some stock market weakness in 2024, it coincided with the outlook that the derivative market has for the Fed funds rate to either start pushing it higher or pushing the cut cycle out, both of which would not be good for the stock market. Now, do you know? I'm not gonna put you on the spot with this one because it's a um, when the when we got our first rate cut in late August, the
Okay.
10-year was at 3.7%. As I sit here 6, 7 weeks later, it's back up to 4.5%. It's where it was. It was where it topped out in the summer. It got up to about 4.6 in June. So we're pretty darn close to the high end. So, with rates at near 2024 highs, if you think that the Fed's going to continue to be able to cut, or you feel like that the 10-year is already discounting a lot of the issues that I brought up with respect to what the Fed's going to be able to do, the bond market might actually be somewhat attractive. And it could be attractive, until maybe we get back down to that mid 3% range for the 10-year. You got to remember, we always talk about you buy a bond and you get that coupon payment. I'm talking about buying bonds for some price appreciation here as rates come down. Yes.
Yeah, and I also like to say, I have recently seen a 20-year home equity loan priced at 10.8%.
Who the
And
heck needs some? Come on. Come on.
that's just like astronomical, right? And that's
Unless you need that because your house is falling apart. If you're going to take that and pay off your credit cards and buy a car, shame on you. Well,
Mhm.
maybe pay off the credit cards.
Yeah. But
Yeah,
the point is a 20-year rate of 10.8 is astronomical.
yeah.
It's again going
You
back to
gotta,
your,
that's a very low, I mean, oh, well, you
but
gotta have
that's
a pretty
getting
low FICO score for that.
but that's also getting back to your idea with the bond market. We're things are if you're selling the debt and you're going to collect almost 11%, that's huge.
Yeah, yeah,
That's a good deal.
yeah. No, it's, I mean, the right, I'm still trying to formulate how I want to go about, but I have gone through all of this. And like I said, I'm just kind of on the sidelines, but I do think I haven't really ever taken a position in bonds in the 30 years or so I've been investing. And I'm actually thinking about looking at some of the bond ETFs that are pretty close to their 2024 lows. and maybe formulating a way to go about trading that. What I had been thinking about doing was taking a position where I expect the 2-year rate to go back up to a premium to the 10-year rate. And
Sure.
there are futures that you can trade at the Chicago Board of Trade, which is part of CME Group, that you actually it's based on the rate going up and down. It's not, that 98.5 bond price. It's actually futures based on the interest rate level. So you could, if you feel like the 2-year is gonna, if we're gonna invert again, you could buy the 2-year and sell the 10-year, and boom, we do like that. But this is more of a 3 to 6 month thought that number comes back down to the 3.5% range. I think the worst case scenario behind maybe buying one of the Treasury bond ETFs is that you're kind of dead money for some time.
Yep.
That I think the worst case scenario is kind of a bottom, but then we
It will.
work our way to the top. So that's what we're saying on the Futurecast. I'm looking at the Futurecast. Is it? Yeah, nothing. Nothing. I think I hit on pretty much everything that we've been talking about. The most common question I've gotten on the road is we actually wrote this before the election. Yeah, and maybe that's why they asked me to do it. Nobody else wanted to. But what I said, and it's funny because I've heard this from a couple of other people since then, but all I said with respect to the election was that I felt they would be equally bad or equally risky for inflation.
Mm,
I think maybe she would have been more than he will be, but both of them are going to do things that would be considered somewhat inflationary. Neither of them seem to be very restrained as far as spending goes. I got to see a former Fed person, a former Treasury official speak, and he was this past week, and he was very, very fired up about the amount of waste that can be cut in DC.
mm,
Something that so we will see, and we'll see how that bleeds through to the overall economy. But also, if the government spending is going to be scaled back, and as he said, some of the GDP growth has come from artificial sources, which I think is his term for government sources. We could see GDP growth with a one handle instead of a 2.1%. That's not going to be good for stocks next year.
nope. Very bad. And with that, we are going to say goodbye. Thank you so much, Dr. Rhodes, for showing us what you've been doing on the Futurecast. We're very excited to see how this plays out in the next year. Also, if you have enjoyed this show, please hit like and please subscribe. And if you have comments or questions or constructive criticism, we're very open to it. Next week's session is actually based on a recommendation. So we're very open. We like hearing from you. We like the interaction, the talking. If we get enough traction, perhaps one day we'll even do a live session so people can chime in and participate. That would be fun for us. Again, we enjoy this. We're open to ideas. So please hit like, and thank you so much for watching.